Very good. Well, welcome along, everyone. This is another instalment of our monthly webinar series. So thanks, everyone, for taking the time to come along. Today, we have Graham Gross presenting from Herron Todd White. He's going to give us a update on the local market with regards to property within CQ. Before I hand over to Graham, I'll just give everyone a quick bit of housekeeping. So if everyone can just make sure their microphones are on mute, it just helps with limiting distractions and background noise. We are recording this webinar as well. So following the conclusion of the webinar, we will send out a copy of the slides that Graham has as well, and also a copy link to the webinar. So if you want to have a look at it later on, or if you want to send it to any family and friends, please feel free to do so. This is a interactive webinar, so Graham's happy to take questions as we go along. So just take yourself off mute. If you're not familiar with Zoom, on your picture, on your video or your name, you should be able to click the mute, unmute button. So feel free to jump in with a question, or you can alternatively do it in the chat box. I'll keep an eye on the chat box throughout the webinar and ask Graham as we go along. And we always, we've sort of got a couple more webinars coming up. So the federal budget's coming up shortly. So we'll be doing another webinar on the federal budget and what the changes. There's likely to be a few changes coming from this webinar, from this budget. So we'll be doing another webinar on that. And next month as well, Risa and Sydney Jones' partner, Melanie Finlay, will be also doing a webinar on how to read vegetation reports. So that'll be an interesting one to come along and listen to as well. So without any further ado, I'll hand over to Graham. Graham, some of you probably already know Graham. He's been a local Rockhampton resident for a long time. He's a managing director of Herron Todd White, and these guys they know property inside and out. So I'll hand over to Graham and he can give us an update on how things are going in CQ.
Fantastic, thank you, Brent, and thanks to everybody at Canars for the invitation and to be a part of this. Just a brief overview of what we're going to talk about. I will just talk about some of the things that are driving our market and then give a bit of an overview on the residential markets in Rockhampton, Mackay, Gladstone and Emerald. We'll have a quick look at the commercial and industrial markets and rural markets, and then I'm happy to have a conversation around what you guys are seeing, what the market's going to do in the next little while. There's certainly a lot of uncertainty out there around COVID and what the federal government and state government are doing with the various stimulus packages. As Brent said, I'm absolutely happy to take questions throughout. I'd rather this be interactive, as interactive as it can be over this sort of format, but really happy to take questions as we go along. Just to further on what Brent was saying, I am Managing Director of Rockhampton and Central Queensland, Herron Todd White. We've got offices in about 7 locations through Central Queensland. I'm happy to take questions on all of those areas. I know a lot more about Rockhampton, and I'll try and answer any questions about the other areas as best I can, but I'm also happy to take questions on notice and come back to you at a later date. I guess the biggest thing affecting our markets around at the moment is this coronavirus. It needs no introduction to any of you, I'm sure. But it's worthy, I think, just to reflect back on where we've been in the last 6 to 8 months. If you think back to around Easter time, I forget the exact date, but Scott Morrison stopped real estate agents having open homes, stopped the way a lot of businesses did business and how people interacted. As a consequence of that, we saw vendors taking houses off the market, thinking that they would never sell. Agents thought they'd never sell a property again because they could never get people through the houses. Sale rates at that particular time had a fairly dramatic fall off. It seems now that we know it was relatively short-lived, but at that time there was an incredible amount of uncertainty and a lot of doom and gloom in the market. I remember stories in the press from some of our clients, our bigger bank clients, some of the biggest companies in Australia, the CBA, NAB. They were talking and forecasting massive drops in property values around Australia in the order of 30 and 40%. There's extreme caution and concern, both vendors and agents and people like us. just really unsure as to where that was all going to go. As we know now, we look back, things haven't turned out quite that badly, at least for people in the regions. And as I will get to through the course of this presentation, some of our markets are doing quite well. The worst hit certainly seems to be tourism, hospitality, and I think there's going to be some massive changes in the retail markets that'll be ongoing as a consequence of people's change of habits and changing of attitudes towards how they shop and where they shop. So in our part of Central Queensland, and certainly the part that I help look after, our biggest areas impacted negatively by this would have to be the Whitsundays and its heavy reliance on international tourism. They've had some compensation from greater tourism from local buyers, but local people don't seem to spend quite as well and stay at quite the top end properties that the overseas people do. So it is negatively impacted, but not as bad as we had first thought. In any property market, the biggest driver, in our opinion, is population. It's about people moving around. And the big drivers for us in this particular period is going to be around the infrastructure projects, which I'll get to, and how that affects population growth. Linked to that, of course, is employment growth. And some charts here in front of you that we've borrowed from our good friends at Capricorn Enterprise and their colleagues at Construction Skills Queensland, who have done some projections on the shortage of labour over the next few years in the Rockhampton area, at least. And they're predicting that we're going to be short some 3,000 to 4,000 to 5,000 people, depending on the timing and scale of the eventual projects, infrastructure projects that happen. And that's going to have, we think, massive effects on our residential property markets and property markets in general. I've got underneath that some charts about from the state government and statisticians. And I've taken one from January this year and reproduced the same thing in July of this year, just to show the contrasts there of how the state government statisticians are predicting a change to employment. In both cases, Central Queensland employment growth is predicted to outstrip employment growth for the rest of the state. So reasonably still good at 2%, even through the COVID process. And you can see in those unemployment rates at the bottom of the page, we're about line ball with the rest of the state. Again, a bit of a borrow from Cap Enterprise. They've succinctly summarised a number of the major projects that are going on around our part of certainly the Rockhampton area of Central Queensland. We think from the information that we've had that Rockhampton Ring Road might be understated there at $1 billion. We think there's probably $4 to $5 billion worth of infrastructure spending happening around Central Queensland, and that doesn't even include some of the bigger projects that the local government have got on and may have on if the levy bank around Rockhampton goes ahead as well. So these are the real drivers that are influencing that demand for people and a greater workforce, which is going to drive population. We've been thinking for probably the last 2 years, I think we've been saying that this is looming and that rental rates had been falling and that the conditions were right for a lift in the residential property markets, and in fact all of the property markets generally through Rockhampton. The other big driver, of course, is the coal industry and the rural industries. And I guess there's a word of caution. This is the latest graph I could find of bulk commodity prices from the RBA. And it's showing that the coking coal price and the thermal coal price has been falling quite a bit in the last 12 months. Export numbers are quite high, so the revenue I think being earned is still reasonable. And what I think this demonstrates from our point of view is that there's a fragility to some of the strength that we're going to talk about, or we've been talking about. There is incredible uncertainty, as I'm sure you're all aware, in the global markets and the macroeconomic drivers around the world. And we don't know where that's going to go. So nothing's certain, and there's still risk in property, don't get me wrong. There's if these coal prices continue to tumble, that will make the viability of some of those mines in Central Queensland perhaps more questionable. And it's those people in those industries that really drive a lot of our markets as well. Just a brief overview of what's going on in the Rockhampton residential market. And what I'm focusing on in these statistics is a narrow part of the market, which is just the 4-bedroom homes. But they're reasonably indicative, I think, of the broader market, and it helps us compare a little better between the centres, because we're looking at more at similar products. What we tend to find is that just the median price for Rockhampton, as compared to Mackay, for instance, can show quite big differences, and that's largely, in our opinion, because of the makeup of the population and the makeup of the housing stock. Rockhampton tends to have a lot of older homes, and we've got our flood affected areas that Mackay doesn't have. And as a consequence, it can be a little bit misleading when we compare across the whole market. So yeah, we've just gone to the 4-bedroom, and what this is clearly showing is a significant upswing through the last period in the rentals for 4-bedroom homes, and we're back up to where some early peaks back at the when the mining boom was still firing on, at about $360 a week for 4-bedroom homes in Rockhampton. You can see that that fall in supply coming through, which is really driving up. Anecdotal evidence from our valuers that are working in these markets that this has continued to climb through the rest of 2020 to where we are now. The vacancy rates are obviously very tight. These latest statistics that we have are back to February. We're fairly certain that they are now down around 1.5% vacancy rate in Rockhampton, which is a really tight market. There is always some vacancy as people move in and out of homes. So this is the environment for rising rental rates, and we're seeing that in spades. The housing market, again, the 4-bedroom houses, the median price now, this graph shows back to 2019, that has continued to rise through 2020. We think that's up around the $400,000 for a 4-bedroom home now as a median price, and that volume of sales has risen dramatically. We're predicting that there'll be somewhere between 325 and 350 houses sold in that sector in the year 2020 based on the first 6 months. So a really return to strength for the Rockhampton market. What we've seen over the years is that over the last few years is a decline in the demand and the value of the cheaper, older stock, the 2-bedroom timber, fibro and tin homes. The market finds those a lot less palatable these days as the cost to renovate them has continued to increase. And what we're finding then is that there's been a real flight to quality. People are less inclined, as I said, to buy those older properties and renovate them. And they're really looking for places that are finished. And the market at the moment is really being driven by the owner-occupier rather than the investor. They're looking for homes that they can move into and they can occupy immediately. So we're finding the lesser quality stock still sitting there. We think that houses in Rockhampton, Yeppoon were showing, up until the beginning of COVID, about a 5% increase on the troughs from 2017. So we were seeing what we thought at that time was the beginning of what we had been predicting, is that the markets were right to start increasing as a consequence of all this infrastructure spending, and at that time, pretty good coal prices. What we have seen in the last few months, since probably May, is that market has just continued to increase, which has surprised and pleased us, I suppose. We think that there's probably been a further 5 to 10% increase in those markets through Central Queensland. And just to compare that to the riverfront apartments, there's a number of resales in those complexes that I'm sure many of you would know. And we start seeing 10 to 15% increases in current resales in those apartments. So that's pretty good solid growth for those people that invested in sort of 2015 through 2018. We've seen houses down at Yeppoon, probably the largest increase we've seen is something around that 20% increase on 2018 values to current contracts. So there's a bit of evidence out there to suggest that the Yeppoon market is even stronger and improving better than some of the Rockhampton markets. It's also been evident through a lot of our development estates. Back 12 months ago, doing some work for development sites, residential development sites in Rockhampton, we thought as a consequence of the slow markets that we'd been through in probably 2015 through 2018, there'd been a reluctance from developers to create a great deal of stock to sell. And as the market was starting to improve in those later parts of, or middle to late parts of 2019, we thought there was probably only about 6 or 8 months supply of allotments in Rockhampton on the sales rates at that time. Wind that forward now to the stimulus packages that the federal government and state government and our local government, in fact, have in place. And the demand for vacant urban allotments has skyrocketed in comparison to what it has been for the last few years. And it's left a real shortage and developers scrambling to get stock developed and through council and built. The sales rates that we're hearing about and experiencing in the work that we do in a number of these estates is well, I can say it was likely to be about one lot a month through the years after 2012, 2013, which doesn't make too many viable estates or estates viable. Those estates are now selling at about 5 to 6 lots a month. And scrambling as hard as they can to develop more lots. And it's fairly uniform across all of those areas, including the Gardens estate, which is, I think, sold about 30 blocks of the 33 that are available there now. So
just quickly, what's driving that particularly, like for that land sales? Is there any particular driver?
Yeah, mate, it's particularly linked to the stimulus packages from the various levels of government. So from the federal and the state and even the local government, Rockhampton Regional Council still have a $5,000 grant for people building their own home, which rounds it out to $50,000 for Rockhampton locals. It's a significant benefit for all of those developers and builders, and it's really just paying dividends for the federal government as they want to stimulate the economy. And this is Australia-wide, right? And it's certainly Queensland-wide. When I talk to my colleagues from the Gold Coast right through to Cairns, they're all experiencing the same thing. Developers were caught unaware. They thought they were heading into a period where there was going to be protracted a struggle for them. And there's very little stock in most places on the ground, and with the stimulus package, it has just accelerated demand beyond expectations. And we're now in this position where there is really strong demand and quite a shortage of blocks. And I think the pressure's on councils and governments to get them approved and to get them developed. So it makes for an environment where there's uplift in value, and we're just starting to see that follow through to value, I think. Hey, Brent, on those questions, mate, I'm not sure if I'm meant to see anything come up, but if people have questions, I guess they can just direct them back through you. Is that?
Yep, I'll yell them out as they come along. Yep.
Cool. All righty. Well, we might move on to Mackay. In the absence of any questions around Rocky, it's a really similar kind of story. I think you'll find that, I'm sorry, just looking back through some of my notes, it's a similar pattern of development. You can see that their rental rate is a little bit higher than Rockhampton for the same sort of property. Again, these are 4-bedroom homes. Rockhampton was sitting there at about $360, $380 a week. But Mackay's on that same trajectory, vacancy rate at around that 1%, employment through the mining industries, and the town is really back.
It appears we've lost Graham there. I'm just going to try and get him back. Is that if you can just drop me a message in the chat box and just confirm that, yeah, we have lost him. I think Lisa said that she's lost him.
Yeah, he's gone.
Okay, just give me 2 seconds, guys. Good old technology. You lost power apparently, so I'm just on the phone trying to sort that out, guys. Thanks for your patience. Yes, we're having some technical difficulties. Graham's in the process of restarting his computer, so we'll see how we go. We'll give him a couple of minutes and see if we can get back up online. If not, we might have to look at alternative solutions. If I knew more about the local property market, I'd try and chime in, but I'll leave that to Graham. Got you there, Darren?
Yeah, look, I was just going to ask a question to the group. I suppose how people are finding things out there, business-wise, property-wise. Like it's interesting times right now, and obviously with JobKeeper, probably for a number of businesses around our region coming to an end, which is in a way is a good thing, but a bit scary. Anyone got some comments, I suppose, on how things are going out there? Everyone's hiding.
What are you seeing, Darren? What are you seeing out there amongst your client base?
It's amazing, and it's like Graham was saying. The regions have been really isolated from a lot of the dramas. You hear stories about CBDs out there now. They're basically becoming, and I haven't been to Brisbane since COVID started, but you can imagine Melbourne right now where everyone's working from home, no one's using public transport as little as possible. And the poor shops, etc., all around those CBD areas, it would just be disastrous. We've been much luckier. It doesn't mean we're out of this by a long shot, and there's still a range of clients who are struggling big time, and we'll keep on getting the reduced JobKeeper going forward. And it's very necessary for those businesses too. Time will tell. It's almost like a day by day, week by week, month by month thing. But there's certainly a lot more optimism now anyway. And optimism is a good thing.
I do wonder, Darren, I did have a question for Graham. I do hear a lot of comments given that like platforms like we're on today, like Zoom and those sorts of platforms that allow people to collaborate remotely, that are we looking at a potential deurbanisation where people want to work, if they can work at home or remotely, do they have to live in the city? Because I know a lot of people are enjoying not having to commute, not having to spend an hour plus on public transport or getting to and from work as a driver for regional areas and potentially property prices with demand and supply and that sort of thing.
I think it's already happening now, Brent. And it's interesting, Graham mentioned before about around Airlie Beach area, the Sundays up there, it's being devastated by a lot of this. But what I'm hearing is that there's a massive push to Southerners buying up around Airlie Beach now. And I think this is happening all around the place. It was just one specific situation I'd heard, and property values are starting to climb and people are relocating. They can do their jobs from home. They don't know how long this is going to be carrying on for. They may as well relocate to sunny Queensland and live in a bit of a better environment, I suppose. But the trend's already happening.
Yep.
It's going to be scary, the long-term trend, and it'd be interesting to hear Graham's thoughts about property values down the track. If these things change, what happens to property values in CBD areas, in the capital cities? There's always winners and losers in these things.
Might try and call and see what's happening again. If not, we might have to abort the mission. I've got his name on the list here. Graham's audio is connecting. You have to unmute yourself there, Graham. There you go. Is your audio gone, Graham? Is everyone else hearing the same thing as me?
Yeah, Graham's got a very high-pitched voice.
Yeah, your audio, something's wrong with your audio, Graham. Sounds like a mouse. Nice one, Lisa.
Yeah, I'm not sure what the problem is, Brent. I don't know.
No, I don't know either, Darren.
Picture seems okay, but
Does that make a difference at all?
There you go.
yes.
Hi, Derek. It's in time for Christmas.
All right.
Very good. Thanks, thanks, Graham.
Yeah, my apologies, everybody. Now, I was, I think, talking about the Mackay market, and again, and experiencing a very similar pattern of sales and value movement as the Rockhampton market, and indeed a lot of the Central Queensland areas. So the Mackay market, again, these are representing the median price and number of sales for 4-bedroom homes, but the rest of the market is taking a fairly similar pattern. We're thinking 2020 sales will be, the median price has probably risen somewhat to about $435,000 to $450,000 now, and we're predicting that the annual sales for 2020, based on the first 6 months, will be something in the order of about 600 to 660 sales. So considerably getting back to a pretty strong market in Mackay, and that demand is still continuing. Gladstone market, it's a similar style. Both Gladstone and Mackay much more aligned to the coal industry. And as a consequence, they had their peak of the market was more around that 2012 to 2014, as opposed to Rockhampton, which was probably higher in 2007 than that 2012, 13, 14 period. The Gladstone market has continued to rise, and again, comparing to Rockhampton in that rental, we're still at about the same rate for very similar quality homes. And the median price in Gladstone through 2020, we think, has lifted again, but much more moderate. They've had a much greater supply to take up in their markets than some of the other Central Queensland markets. There has been a lift and a lift in the sales numbers through 2020 on the evidence that we've got in the first 6 months. These are still considerably well below the 2007 and 2012 markets, but a return to strength for all of those markets. And I'll just have a quick look to the emerald market. Again, you'll see similar patterns where over the last half dozen to dozen quarters, there's been growth in the residential rents for property, generally a falling take-up rate of new rents as the supply is taken up. And again, growth, significant growth from the bottom of the market through to now. We're thinking that the emerald market through to 2020 is probably more like 370 to 400 as a median price for that style of home, and we're expecting that the number of sales will be approaching that 150 sales in 2020. So much stronger than it has been in the previous years, but still not quite where we're at, where we were, I guess, in the peak of the market. In all of these markets, it's really still being driven by the local buyers. It's the local participants, rather than in earlier booms, were generally driven by the non-local investors. If you think back to those busier times as the mining boom increased, what was driving our market, or at least what kicked them off, was the interest from non-local investors as the Melbourne and Sydney buyers took advantage of the opportunities, and through a lot of the marketing that was going on at the time, were very active in driving our markets up. You got a question there, Brent?
Yeah, do you think, like we were talking while you're offline there, like you're saying there that local investors are sort of taking up a lot of the slack here. Do you foresee, we're talking about the concept of deurbanisation and people potentially, being able to work remotely now, will that drive a lot more people up to sort of Central Queensland areas and fleeing from the south?
Yeah, look, I think that's a reasonable expectation, but they're just projections at this stage. There's a lot of talk around that sort of thing, but of course those people won't be focused just on Central Queensland. They'll be looking for opportunities through all of regional Australia. Just the scale of that there's a big question mark around it. I know, speaking to colleagues and other professions in the capital cities, there's already a lot of talk around this. There are a lot of businesses and I think a lot of government departments over the next 5 years or so that are going to be reviewing a lot of their policies about how and where they do business. What we've seen in the last, 20 odd years has been a centralisation of a lot of those industries to Canberra, to Melbourne, to Sydney. That was the rationale of the business leaders and the government leaders at the time. And I think a lot of that might be brought into question now, and I think there might be a preparedness for some of those government departments and industries to look at the opportunity to de-risk their businesses by locating some of their staff outside of the CBDs, where they're really struggling to get people into them. And we just don't know what those what safe work practices are going to be like. I don't know how many of you have been back to any of the capital cities in the last little while. I've had a couple of trips down to Brisbane, and it's very difficult for the businesses in those big office towers to get their staff to work because of the size of the lifts to practice any sort of social distancing. Now, you can't go and retrofit those buildings with more lifts or bigger lifts. They are what they are. So there's going to be some real structural problems for some of those businesses, I think. And they will be looking at how they de-risk their operations. But I think that, Brent, will be something that happens over a long period of time and a lot of consultation. And there's a lot of attitudes that are going to have to change before the behaviours change around where people choose to live. We're not seeing any evidence or any significant evidence at this stage of that movement.
Well, it will be interesting because speaking about trying to get people back into work, my wife works for the government and they're trying to get their numbers back up because they've got offices that normally house, 50, 60 people with half a dozen people in there. So.
Yeah, that's right. And look, I've got a daughter that works for one of the big accounting firms, Deloitte in Brisbane, and they've done their sums and to get everybody to work in the building that they have, and they have 5 floors down there in Creek Street somewhere or other. If they were going to practice social distancing in the lift and weren't allowing any other business into the lift, it's sort of 4 p.m. before the last person actually gets to work, such as the traffic jam in the lifts. So they've got massive problems, and those businesses are going to have to deal with that, and a lot of government departments. So look, one of the big things that we don't know in that is how the community is going to react when people ask them to cram back in like sardines into a lift again. Will they do it or won't they? I don't know. But I think there's great opportunity. There's great opportunity in all of that for our regional leaders to help facilitate some of that change, and our government representatives to really bring some of those government services back to the regions. It'd be great to see more of the public servants out of the capital cities.
I should keep going, just because in interest of time, I know you've got to be somewhere by 6 o'clock too.
Absolutely. That's a sort of the overview of those residential markets. I just thought I'd talk a little bit about the commercial and industrial markets, and I'm talking mainly here about the investment opportunities that are out there in commercial and industrial property. We have seen in that residential, and I think I mentioned it, maybe I didn't harp on about it, but there's a real flight to quality, that the buyers that are out there and they're active in the market are looking for properties that are complete and ready to move into. They're not looking for the renovators at this stage in this part of the cycle. And it's a little bit the same in the commercial property, industrial property markets. There is strong demand out there for leased property. There is relatively weak demand out there for vacant property. There is still some owner-occupiers that are active in the market. But what we tend to find is that they've been trying to buy the properties that they're already occupying rather than relocating. There's a lot of participants in these markets, I think, that have a collective view that interest rates are going to be fairly low for quite a period of time. And a lot of people active in these markets are able to borrow at that sort of 3 to 3.5% interest rate. So we see properties like, and some of you in Rockhampton may be familiar with some of these, the new tyre place in Bersica Street that sold very late last year. This is a strong tenant, a national tenant with a long unexpired lease term, and these properties, it's fairly typical of those properties selling down in that sub 7% yield. Really strong demand and a lot of buyers out there, particularly given the price point of being sub $2 million. There's also that property at the bottom of the page there would also be well known to the Rockhampton people, sold off market transaction at an 8.5% yield. Again, not a national tenant, but a very strong and well proven tenant. And there's plenty of people out there chasing these sorts of investment opportunities. Contrasting that, older properties well located but with local businesses inside, and typically tend to have shorter leases. So this property selling with a 2.4 year WALE, selling at about 8%, that slightly higher yield. But this, what we're seeing in the market, and particularly in the last 3 to 4 months, is a really strong demand for this sort of property. There's buyers from all over Australia that are active and looking for a home for their money. As I said, they're selling at, or they're borrowing at around that 3 to 3.5% interest rate. So a net return of 8% is really attractive and a positive cash flow for many of them. And of course, for the tenants, it's cheaper to own these properties and pay interest than it is to pay rent. Yeah, Brent.
I know, just interest rates generally, it seems to be going to be low for long. So I can, understand that the need or want for people to be sort of seeking out these sorts of assets with quality tenants.
Yeah, what we're seeing is that they get snapped up really, really quickly, and a lot of them that we've been valuing haven't even got to the open market. The agents are aware of that many people that are chasing them. They've got lists of buyers, and before they can even get an ad printed or an ad loaded up onto the various websites, there's offers streaming in that are attractive for the vendors, and they're usually sold extremely quickly. Similarly, for the specialised assets and like things like this service station in West Gladstone are really national markets. There's buyers that are just hungry for this sort of thing, and for childcare centres as well. This is a much higher price point at about that $5 million mark, and still those yields are very, very tight. These are good quality new assets with really strong lease covenants. And the market is just hungry for them. Contrasting that with Mackay, and this is a very similar story. Pardon me, you can see in that first one at Mitchell Moore Street, again, a fairly high price point, but a good, strong tenant, good long unexpired lease term, and a yield at around that 8%. And you can see that all the way through, the difference being that last one in Discovery Lane, a local business, a lower price point on the property, but also a shorter WALE has kept that yield at that point. So, and really strong demand for these properties. They're typically not requiring a lot of time on the market to find a buyer. And I'll pause just for a second. That was about all I was going to talk and share around those commercial markets. Just a brief discussion around what the yields are for those investment properties. There is still good demand for going concern properties. Generally, although the accommodation industry has been really quiet, there haven't been too many motel sales in the last 12 months. Having said that, the caravan park sales have continued. We've got a couple of sales of those in that circa $5 million in the local tourism areas, Harvey Bay and the like, that are showing pretty good yields. The rural markets, I won't dwell on on this for too long, but it's a really interesting market, and it's got different drivers, of course, to a lot of the things that the markets that we've been talking about so far. This is just a graph to show some long-term growth trends of the returns people have been getting out of investment in rural lands from capital growth. And that long term at the bottom there, about 4.5% per annum over the extracted period. Most recently, and these graphs go to 2019, has been some significant growth. And this is showing us the total value of broadacre grazing properties that are sold through Queensland, just rising to unprecedented levels. It's our understanding and our analysis of the 2020 market so far that we will exceed this by probably a considerable margin. The market out there for rural lands is just white hot at the moment, particularly around the grazing industry. Largely to do with, in fact, I might just flick through it, to commodity prices. This graph was done in the earlier part of this year, around March. So on a full year 2019 statistics, and the Eastern Young Cattle Indicator at that time had slumped to around 500 points. Just checking that before we came online, I think that's up in the middle 700s now, up at record prices. So what's happening here, we think, in these markets is the return on investment has just never been better. Interest rates for a lot of these buyers in these markets are at record lows, down for similar to the commercial properties, down around that 3%, and the commodity price is extraordinarily high. What that means is that they're just getting returns and like they've never got before, and as a consequence, they're continuing to buy property, and particularly the good quality property. It's a bit the same as I was saying with the commercial and the residential, in fact, where there's this real flight to quality. For the better quality, that blue ribbon grazing property, we've seen capital growth in the last 12 months of 20 to 30%. It's just extraordinary growth through some of those markets. And it hasn't been uniform in that analysis of the market on a rate per hectare basis. It's been quite extraordinary, and you can see that it's been getting quite high in that Fitzroy area, with that red arrow where a lot of the better quality properties are. But overall through Queensland, you can see down the bottom end that rate per hectare has dropped. And that's not to say that the values have come back in any way, but what it's indicating is that as those better quality properties are even more tightly held, few of them coming on the market, the buyers that are in the market are looking further afield and further west to bigger properties and paying a lower rate per hectare for those. So some changing dynamics through that market, but it's super strong and white hot market. Brent, that takes us to about 20 past 5, even with our little hiccup in technology, which I again apologise for. I will just pause at this point, mate, and happy to take any questions that people might have.
Thanks, Graham. No, thanks very much. That was a great overview and some really good examples there of what's sort of going on. There was one question raised a bit earlier, and I'm just conscious of time for everyone. Could you give any insights, please, into the future market update which you've done, and looking at, in particular, selling brick ground level unit complexes that have either 2 or 3 units in residential suburban settings?
Fairly specific. I think Look, if they're relatively new units, and they will appeal to the buyers that are active in the market at the moment. So I would expect that to stay relatively strong for quite a while yet. I think as I'd go back to those things that are driving the market and the demand for rental accommodation for those workers that are coming into the Central Queensland area. I think that sort of product would be pretty keenly sought after and attractive in that market.
No worries. Look, that's all. That's all. I think the questions that have come through. I'll throw to the floor. Anyone want to unmute themselves and ask any questions of Graham before we wrap up the webinar?
Yeah, can you hear me?
I can, Lisa.
Yeah, it's Lisa. Yeah. So, do you think our markets will continue to improve and values increase even if the world economy tanks with the COVID-19? Because we're a little bit insulated, and I'd have to admit I've got a motel and I've got a servo, and as soon as trading opened back up for the motel, we're straight back to 90% occupancy. So that's definitely a win there when the markets close you down to 10% occupancy. But we've actually seen an increase in the fuel industry and the takeaway. So definitely no downturn here, but we're just sort of wondering, as the rest of the world sort of tightens and really has a different experience once again to Australia, will that affect our pricing?
Ultimately, I think it can, Lisa, absolutely. At the moment, we're somewhat insulated from all of that because of the stimulus packages that the governments have got out there. So that's the other big unknown in all of that. But certainly, if the global, and I showed earlier the fall in the coking coal and thermal coal price over the last 12 months, I think that's brought about, and I'm no expert in global markets, but just the fragility of those deals that are happening in that market. And if that falls, and if China continues to slow, India continues to slow, if we can't get on top of that virus and sort of worst case scenario, then it seems logical to me that the demand for iron ore and coal is going to fall, and that will have dramatic ramifications through our part of Queensland and our industry. So yeah, we're prone to it, and I did mention early on when that slide was up, just the fragility of our markets in that regard. At the moment, they're quite strong, and I think there's a lot of people enjoying making hay while the sun shines. So
I was going to say, should we sell quick?
I'll stand back from giving financial advice and leave that to the good guys at Canars.
Thank you.
But, there's risk out there, absolutely.
Yeah.
Very good. Well, in the absence of any questions, please feel free to send them through to myself. We can forward them on to Graham, and Graham said he's happy to answer those. So in the interest of time, we might call it time there. Graham, thanks very much for your time and your expertise, and giving us a great overview of the Central Queensland property market.
Super. Thank you for the opportunity.
Thank you. And thanks everyone for attending. We will follow up again with a copy of the slides, a copy of the presentation as well. We will see if we can edit out that little technical glitch there if you want to re-listen to anything. And keep your eyes peeled for the next webinar, which we're going to do a budget update. And any feedback that you have, please pass that on to us. We're going to send a survey. We've now made it only 3 questions. It'll take you less than a minute. You've just got to tick on the star box. I think Susie's amended that for us. So, but we're just really chasing any feedback so we can deliver valuable information that's sort of going to meet your requirements. So thanks again, everyone. Have a good night. Enjoy the rest of the night, and we'll talk to you soon.
Thank you.
Thanks, Brett. Thanks, Graham.
Thank you,
everybody.